Bassel Khatoun is the Chief Investment Officer of Mena Equities at Franklin Templeton Investments Middle East Limited. He is responsible for the investment process, research and performance of the Mena Equity team. He is the co-fund manager of the Franklin Mena Fund and Franklin Middle East and North Africa Fund. He holds a BA degree with first-class honors in philosophy, politics and economics from Oxford University. He had previously worked in Algebra Capital, where he was involved in the establishment of the firm's flagship equity funds and was a member of the Equity Investment Committee. He had also worked in the investment banking division of Citigroup in London. Please welcome Bassel Khatoun.
So thank you very much, ladies and gentlemen. It gives me great pleasure to speak with you today. The Middle East and North Africa region today is rising in terms of its importance in the global economy. The region today is home to 190 million people, young, growing, with consumption needs that are evolving. This is a region that today is a $2 trillion economy, which, to put into a context, is larger than Canada, it's larger than Russia, and approximately the same size as the Indian economy. Today, the region is also home to about 30% of the global oil reserves, massive natural resource reserves, which are going to fund huge infrastructure projects going forward. So our definition of this region really comprises 11 very diverse countries, from Oman in the east to Morocco in the west. And as we say, this is a region whose prominence in the global economy continues to grow. Now, having said this, as a region, the Middle East and North Africa continues to be very much underrepresented as an equity asset class. So what do I mean by this? Well, today, Middle East and North Africa represents about 3% of the world's GDP. However, it's only 20 basis points of the Msci world. Similarly, MENA represents about 7% of the emerging markets GDP, but only constitutes 2.6% of the Msci emerging markets index. So clearly, there is a material disconnect between the weight of MENA in terms of its economic weight and its equity market representation. And that's a material disconnect that we hope will change over time as our capital markets grow and as our capital markets open up to further reform and increasing foreign investment. So we already see very interesting signs of that transition and very early signs of promise. Now, I want to dispel a very common myth. Most people associate this region with just oil. And in our interpretation, that's very much a misconception. We believe the economies of the MENA region are quite diversified. Clearly, there is a lot of social, economic, political, and cultural ties that bind these countries together. But they're by no means homogeneous. In our 11 countries, there are about 6 countries which have a material representation of oil in their GDP. Those countries form part of the GCC, and they share very common characteristics: very low debt levels, very high government reserves, and huge ambitious spending plans. But similarly, we invest in 5 other countries that are actually oil importing countries. Those countries rely on consumption, they rely on industry, they rely on tourism, and they rely on agriculture for their growth. So these are much more typical emerging market economies and very different to the economies of the GCC. So that diversity within the region, within the MENA region, really gives us a lot of flexibility to shift our assets in terms of oil exporters and oil importers, depending on the commodity cycle. And actually, what we've noticed over time is even within the MENA bloc as a whole, we've seen a broad range of performances amongst the markets as well as very low correlations between the equity markets of the region. So, as an example, in 2015, the Jordanian and Lebanese markets were up 5%. At the same time, the Egyptian equity market was down 25%. If you look year to date, Morocco is up about 11%, where you have the likes of Qatar and Kuwait that are down 5%. So clearly viewing this region as just one homogeneous set or one trade is a bit misguided. So I want to move on a little bit to the equity investment case of the region. Today, there are a number of challenges globally. We believe that looking ahead, investors are going to start scrutinizing asset classes, geographies, a lot more carefully. The era of cheap money through quantitative easing is slowly changing. The Fed has already signaled yesterday its willingness to continue raising interest rates. And as that course transpires, we would expect investors to start taking a closer look at the economic fundamentals that underpin the equity investments that they're making. And in that context, we highlight Mena as being quite a strong case. So from our perspective, a lot more diversity in performance, a lot more divergence in performance within emerging markets and globally across asset classes. Now, there are a number of issues that today plague the investment landscape globally. We have concerns about a slowdown in China. We have concerns about the impact of rising rates. We have concerns about geopolitics. And in particular, and very relevant to this region, concerns about the prevailing oil price environment. So it's really in that context that I want to frame with you the investment thesis for the MENA region. First of all, we believe that the MENA region is very well positioned to withstand a lower oil price environment. Yes, GCC governments will probably sustain fiscal deficits of anywhere between 0 to 20% this year. That won't be a surprise to anyone, and in of itself, that's not a particularly interesting point. However, over the last decade, as a result of elevated oil prices, these economies have become some of the richest economies in the world. They've substantially paid down all of their debt. So the average debt to GDP in the GCC region is 15%. And they've built up a vast pool of reserves equivalent to 200% of GDP that position them very, very strongly to withstand against lower oil prices for a long period of time. That's very different to some of the other oil exporters that we compare against. When you consider, for example, the fiscal break-even and economic vulnerability of a country like Russia or Iran or Venezuela, MENA compares very favorably from a balance sheet and fiscal perspective. So that's the first point. The second point is that we've been incredibly encouraged by the readiness of the governments in this region to undertake reform. Around about mid-2014, late 2014, well into halfway through last year, we became increasingly concerned as investors that the governments of the region were effectively not being proactive enough and expecting a rebound in oil prices to do their hard work. Now that's changed. And for us, that's incredibly comforting. So in the December budgets, we saw for the first time a real initiative to reform and take substantial subsidy decisions and policy decisions by these governments. And that's very important. You know, these governments have made some very difficult decisions. They've effectively reduced subsidies. They've increased energy prices, they've increased water prices, utility prices. You will have all heard about the plans to implement VAT in a few years' time. In countries like Oman and Kuwait, corporate taxes are being touted or increased. So these are very difficult decisions that the government has shown a readiness and willingness to adopt. And in our opinion, that puts these economies on a much more sustainable footing over the long term. So for fixed income investors, as debt investors, that bodes very well. Strong balance sheets and very proactive reform. But what about equity investors? Has this reform crippled the growth outlook for the region? Are we now operating in a subpar environment of growth because of these reform initiatives? Well, we believe not. And we believe that the budgets that have come out really indicate a very balanced approach between reform on the one hand and reducing fiscal deficits, whilst at the same time continuing a fiscal environment that promotes growth. And it seems that the IMF actually agrees with our interpretation. So if we look at the IMF forecasts, the IMF is forecasting for oil GDP of about 1% in 2016. That's very low by all standards. The non-oil sector is actually growing at 3.5%. So roughly 3.5 times the rate of growth that you see in the oil sector. And that for us, as equity investors, is really where the exciting investment opportunities arise. So for example, in Qatar, it's about the massive infrastructure spending, the need to build roads, railways, bridges in advance of the Qatar 2022 World Cup. In Saudi Arabia, it's about the development of affordable housing. There's a shortage of about 1 million homes in the affordable section in Saudi Arabia, for which there's strong impetus to build. And in the UAE, we continue to see the government evolve and the economy evolve as a tourist destination, as a trade hub, and as a financial center of the world. Now, I'm not saying that the growth outlook is entirely rosy. The non-oil growth projections have been brought down from about 4% or 4.5% 18 months ago to about 3%. So clearly, it's not all rosy, but 3.5% non-oil growth in an environment where global growth is starved is not too bad. Now let's think about the transmission of non-oil growth into the equity markets, because as equity investors, that's really what we care about. And what's interesting here, and may come as some surprise to many of you, is that energy only represents 2% of the mean equity market capitalization. 2%. In the Dow Jones and in the S&P in the US, for example, energy represents about 8% of the index. And in the emerging markets, energy represents another 7% of the Msci emerging markets. So in essence, the mean equity markets give you exposure to every sector outside of energy, or almost any sector outside of energy. And we know that that's because most of the energy assets remain owned directly by the government itself. So what does that mean for corporate earnings? Well, as a result of the minimal representation of energy, corporate earnings forecasts have remained stubbornly high. So if you look at Bloomberg consensus forecasts today, Bloomberg anticipates 10% earnings growth in MENA this year, whilst at the same time, emerging markets growth is expected to be flat. So we believe that the lack of representation of energy has actually helped the region avoid these downgrades in consensus. And although a 10% earnings trajectory is lower than what we've seen in the past, that is still very healthy and very optimistic in the context of, for example, the US that is going through its fourth quarter of negative earnings. So once again, we remain resilient in a global context. Now, what have the equity markets priced in? Well, we believe they've priced in a lot of negativity. Today, regional equity markets trade at about 11 times earnings. That puts them at about a 25% discount to their historical valuation level. They're trading in line with emerging markets valuations, to which they've typically traded at a premium. So, lots of negativity already in the price of MENA equities. Similarly, the region offers a 4.2% dividend yield. Now that dividend yield is dollar pegged and it's tax-free. And that compares very favorably to a 2.6% yield globally or a 2.9% dividend yield in emerging markets. In fact, that yield probably masks the reality. The reality is that there's a lot of companies that are in high growth phase that aren't paying dividends, and there are many mature companies offering dividend yields of about 7%. We actually believe that dividend payout ratios can increase further. Companies are sitting on record levels of cash and have historically low dividend payout ratios. So this dividend yield actually serves to protect investors in periods of downside or in periods of volatility. Now, I just want to hammer home this point about oil price and our correlation to oil prices. Over the last 5 years, MENA equities have shown a 10% correlation to oil prices. That's very low. For anyone looking at equity markets, you'll probably be scratching your heads thinking how this actually stacks up. The reality is that in a very short time frame, MENA markets do respond to oil prices. They move lockstep with oil prices when there are significant short-term swings in oil. But over long periods of time, typically fundamentals take hold and equity markets diverge. So over the last 24 months, oil prices are down 51%, and MENA equity markets are down about 20%, again showing a high degree of resilience to the oil price environment. Similarly, MENA shows a very low correlation to both emerging markets and global indices. MENA has only a 24% correlation to the MSCI World and a 34% correlation to MSCI emerging markets. Now, the MSCI emerging markets and the MSCI World have about a 70% correlation. So in this world of increasing global financial interconnectedness and complexity, and as asset classes tend to trend and move hand in hand, this is a very interesting way for investors to diversify their holdings into something that actually is non-correlated to global indices. And the rationale for that is quite simple. MENA so far has a very low constituent of foreign investors, and what drives our markets is local money and local retail money, to be specific. But that's an aspect that might be changing, and changing for the better. And this is really the sort of sweetener in the MENA equity investment case. In 2014, the MSCI upgraded UAE and Qatar from frontier status to emerging market status. That brought with it significant flows of capital. Equity markets rallied considerably in that year. In the case of the UAE, equity markets rallied over 100%. And it was a milestone event for the entire region, bringing it back onto the investment radar of international investors. But the bigger story is really Saudi Arabia. Saudi Arabia today represents 50% of the region's GDP, 50% of the market cap of the region. And only last year, Saudi Arabia decided to open its market to foreign direct investment. Now that was a massive step forward. But equally important is Saudi Arabia moving into the Msci emerging markets. And we believe that over a 24-month period, that will happen. So, on today's foreign ownership criteria, Saudi is likely to command a 3% market share in the Msci emerging markets. But the big swing factor here is Saudi Aramco. And all of you will have heard of the government plans to potentially privatize and list Saudi Aramco. Saudi Aramco will be by far the largest company in the world, and should it be included in the Msci emerging markets, alone will have a 3% market share. It will be the largest company in the index, dethroning Samsung Electronics, and as a result, the combined weight of Saudi Arabia in Msci emerging markets in the next few years could be as large as 6%. So when you add Saudi's potential size of 6% to the existing share of UAE and Qatar, which is 2%, you see a combined weight of Mena in Msci emerging markets of 8%. Now that's much closer in line to its economic contribution of 7% that we started off with. That's going to bring significant flows of capital. Anywhere up to $30 billion can flow in advance of this upgrade of Saudi Arabia. And that gives investors today a huge incentive to be positioned before the fact, before the upgrade, to participate in that rally. So when we think of the MENA region, and we think about it as an equity component, over the next few years, we would anticipate MENA becoming a sizable block in the Msci emerging markets. It will become the 4th largest block behind Taiwan and larger than, dare I say it, India. So we believe that the region is establishing itself as a single identifiable subset within the emerging markets landscape, similar to LATAM, similar to Southeast Asia, and similar to emerging Europe. And that provides a great liquidity incentive to be invested in these markets. Ladies and gentlemen, just a couple of concluding remarks. The investment climate that we're operating in today is challenged. Risks prevail across political, economic, and central bank parameters. In that context, we believe that emerging market and global investors will gravitate towards countries and areas that have sound fiscal standing, which is represented in this region, that are showing a willingness to initiate reform and adapt to the prevailing economic environment, which this region is doing, that will continue to show a robust growth outlook in spite of the challenges, and where a lot of negativity has already been priced into equity markets. And for that, ladies and gentlemen, we believe that the way forward in this region is through local participants that can actively manage these portfolios to extract their potential to the utmost. Thank you very much for your kind attention and your time.